Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm your host, Dr. Alan Lomax, and it's a pleasure to be with you today as we explore the important element of using real estate investing to build legacy. Daniel Farber is the CEO of HLC Equity and responsible for leading the executive team on strategy and execution of growth for HLC Equity's investment portfolio, and he leads the group's operating businesses and brands. So we are pleased to have Daniel with us. So Daniel, take us into the show by sharing a memorable experience from your formative years that helped to shape who you are today.
Sure. Well, thank you very much, and I appreciate it. So, when you ask the question, obviously there are lots. Every day there's some sort of memorable experience that impacts, but I think that what kind of stuck out right away was actually a negative thing that happened, which eventually turned positive. So when I was 18, feeling very young, healthy, vibrant, and actually on my way about to join the military in Israel, suddenly I had a back injury, which came out of nowhere. I was just running and I felt a little irk in my back, and I had 2 slip discs in my back. And for me, that was like, it crushed my plans, and I didn't know what I was going to do. And it turned into it was this big thing, and it took months of recovery. Slip discs, they sound very bad. And so when the doctor told me that, I thought it was very bad, and it felt very bad because they really do. But then when you really dig in, especially when you're younger, they're actually, highly treatable, and you can live with them and you can actually thrive with them. And so that really forced me to focus in on kind of more important exercise, like core exercise, and just overall being strong in my body, and then also the mental ways of dealing with it. And so that got me to a rhythm of basically being forced to try and stay in shape, because if not, then I just fall apart. And it's something that I'm constantly trying to work on, and it comes back, and I have recurrences. But it's definitely something that has there's many other examples, but that's something that kind of sticks out as something that started as a negative, and kind of just try to make the most positive out of it as possible.
Well, a good lesson to learn, particularly for an 18-year-old. It's not curable, so you still have the slip disc. You just have to learn to live with them. Is that the case?
Yeah. And there are books on it, and there's all types of different mental games that you can actually play, and you can learn the connection between your mind and your body and how it influences. Mm-hmm. And so that it really has been a learning experience, dealing with it. And, thankfully I consider it a minor issue compared to the many issues that are out there health-wise, but it's just something that, that kind of has been a learning experience.
Well, mind, body, and spirit are certainly things we all need to pay attention to, and often don't until something stops us like that and makes us pay attention to it.
Yeah.
Well, very good. Well, Daniel, tell us what you mean by legacy.
Sure. So, legacy obviously can mean a whole lot to different people. And I think that's kind of, that's what's special about it, in the sense that a legacy can be a book that somebody leaves for someone, right? Values that people leave for someone, and that you teach. I mean, that is definitely, when we speak of legacy, that's definitely a big part of it. And then obviously on the investment side, we have the financial side of a financial legacy, and how are people able to, build up enough financial stability in order to be able to leave something, and also just generally create something. And the interesting thing about it is that if you are able to build up that sort of financial legacy, it gives you a whole lot of more time and freedom to focus on what a lot of people may consider the more important legacy items, like values, time spent with family, in religion, faith, all that stuff.
Well, you say that legacy is your big why for investing in real estate. What makes it the big why?
Well, so I think that real estate, for me, it's 2 different things, right? So I have my job, which is, we at HLC Equity now took an investment platform and we built it out into something that offers a passive investment in real estate for people. So my day job, that is what I do, is we work constantly for passive investors. Now, I'm also enjoying that and benefiting from it, because I'm invested passively also in all of our deals. And that is really where we're able to kind of like build that legacy. So obviously, like as a young professional, I'm able to work in the work that I enjoy doing because I love what we're doing. I love, what we're building. I love the people that we're working with and what we're building. That's my profession. And I'm also able to put savings and my investment dollars into this passive investment that grows, appreciates, tax-wise depreciates, and offers passive income, to offset the expenses of life.
Well, what are the key components of investing for multi-generational legacy?
Yeah, I think that the most important component in my mind is the kind of taking the long-term approach versus short-term thinking. I think that especially in today's day and age, Robinhood, stock market, crypto, all of those, asset classes have their benefits, and I'm not against any one of them. And I think, like that, I'm not trying to serve. This isn't a financial advisor interview, so I'm not going to speak to what the percentages should be or shouldn't be. But I think that, real estate within that context, it really proven that over time, when you hold real estate and it's solid real estate that's bought right, and it's financed well over the long term, you can benefit. So I think that's one of the key factors. And that obviously plays also into legacy because, legacy is a long-term play. It's not a short-term type of play.
Well, you talk about long-term and short-term, and you've mentioned, I guess, some of the examples of short-term are Robinhood, cryptocurrencies, different things like that. Well, what is the big difference really between long-term and short-term?
So, I think that let me take it here. So it used to be, if we go back into what real estate used to be consolidated into dozens of families that were extremely wealthy, and they owned most of the real estate in a city, a town, whatever it may be. And they just held it. If you were lucky enough to be one of those, maybe, in New York, it was something like 12 families, right? In every city kind of has these few families. If you were lucky enough to be in that bunch, really the way that they benefited and they really grew their wealth was holding out over the long term and holding the real estate, benefiting from the, all the benefits of real estate, appreciation, depreciation, passive income, and refinancing, not paying taxes on constant sales, and so on and so forth. Today, the real estate market is much different. Investors have kind of like, they've gotten used to some of these new features that are out there, which is like, hey, we have a real estate deal and it's, a 2-year hold, which, there are some deals that should be, that. But when we're talking about really building up a real estate portfolio for the long term, the better play is not to, get into a deal, pay a bunch of expenses to get in that deal, then be in the deal for a little bit. Yeah, you may have even, doubled your money, but then you paid a bunch of taxes, got it out, and then you sit around for another 3, 4, maybe half a year, sometimes much more, and say, okay, well, how do I reinvest it? But if you keep it invested, generate income, and then with that income, use a percentage that you may want, for your life or whatever it may be, and reinvest the rest. I think that's what, when we talk about long-term investments and really building impactful legacies, that's really what it's about.
So even in real estate, you could have short-term investments, and it just depends on your investment strategy. I guess some people do use that short-term, but the long-term is really where you're going to go to actually develop that legacy wealth. And from my perspective, that certainly is where you're going to get all of the benefits. You're going to get the appreciation, the depreciation, the leverage, and all of those very important things to real estate investing. And yet I know there are people who are doing this on a short-term basis. I frankly don't understand them. It's just, I don't know, they're missing out on so much. Go ahead.
Right. No, well, yes, I agree. And, there are transactions that we've done where, especially with investors, where there's a certain expectation for a shorter term investment. And if it makes sense and we do sell within 2 years and we deliver a phenomenal return to our investors, we have done that. And I'm not bashing that. I don't think it's worse, but if you're talking about long-term and really benefiting from the benefits of real estate, then it is a long-term play. And for those people that think that it should only be about the shorter term investments, I encourage them to look at a closing statement of a real estate transaction so they can realize how many taxes they pay and title fees and all these fees that add up every single closing, as opposed to just keeping it invested, refinancing it in order to pull out cash. and to continue with the investment and to build up a long-term portfolio.
Yes, it's very expensive to transfer property. I mean, attorney fees, inspection fees, all the various different transfer taxes you're talking about, the list goes on and on. So there are different classes, of course, in real estate. Take us through some of the different classes and the different impacts upon legacy with these different classes.
Sure, definitely. So our main focus at HLC Equity right now is not what we originally started on. So again, we're a 70 plus year, multi-generational real estate investment company. So we've seen several different cycles, throughout the firm history, how different asset classes have performed. So right now, our main focus is the multifamily space in specific growth markets. And so, within multifamily, we buy basically 100 plus units. We used to focus more on value add deals. We don't think that the actual value are primarily in a lot of those value add deals that we see today. So we're actually more focused on owning high quality core plus type of properties that can last over a 10 to 20 year period and remain very healthy, in terms of the bones of the building and the financials and so forth. Then an asset class that we actually used to be very involved in, we still do have some involvement, and we do manage a legacy portfolio, is in the net lease space. So major tenants like CVS and Walgreens and Staples and the list goes on and on and on. All of the major retailers, basically they rent their buildings from us. Most circumstances, especially if it's a triple net lease, they are responsible for the vast majority of the expenses. When we were buying it, the cap rates that we were able to buy it at were very attractive, and the spread that we could make and the overall return could make was very attractive. Those returns have gone down as the economy got hotter and hotter. But overall, there can be very interesting deals found within that net lease space. And we also have dealt with just retail shopping centers and so forth. Right now, there's obviously a lot of turmoil in that space between everything going on with the economy, and obviously e-commerce has shifted that asset class in a big way. It doesn't mean that there aren't good investments in that asset class, but it's a lot more challenging than it used to be.
So talk to us a little bit about multifamily, and you talked about value add properties, which do so much of now, but do the high quality core properties. What is the difference between a value add and a high quality core property?
Sure. So what we traditionally used to do with our value add deals is we basically, you're buying slightly older building, call it something that was built in the 1970s, 1980s, sometimes 1990s. They're older. They need, a lot of fixing up both within the units and also outside of the units. So you go in, you have a big capital budget, and you go in and you make these enhancements. And for those enhancements, there's a very clear calculation. If I invest, call it $4,000 in this unit, I expect to receive, call it $100 on each unit, and you have that calculation which you run through the entire property. That made a lot of sense over the last few years, and it also made a lot of sense financially. It also made a lot of sense because we were improving the communities that we operate, right? So we were able to bring them up and make them nicer, and they just needed a little, love and care. As the economy got hotter and hotter and hotter, cap rates, basically the relationship between the income and the values we're able to buy it at, they became, more compressed and more compressed and more compressed. All of a sudden, we felt like, if we're paying such a low cap rate for these value add deals, we might as well get a really, nice building, because they were, basically trading at the same cap rates. And now they're maybe a little bit, a cap rate on a nice building, maybe little bit lower, but it's not nearly the same amount of capital expenses you need to make, a lot less risk to it. And the sentiment up there, maybe a greater recession coming. I don't play the game of trying to forecast what will be or won't be. My job is to be prepared for any circumstance. So, the thought is these are high quality buildings that are, considered Class A, but that's garden style. So we're not talking ultra luxury stuff that, people can afford within the metros where we are, but they're very nice, beautiful buildings, and they are built usually in 2000 and newer. So, last year we bought a building that was built in 2008 and 2013. We just bought a brand new building from the developer. So we come to an arrangement where they develop it and we take the risk of leasing up the property, because we, have confidence that we'll be able to lease it up. we get a little bit of a discount for that. It's a great arrangement for the developer, great arrangement for us. And then we have a brand new Class A building, which is what we just, a property we just closed on about a month or two ago.
Sounds like a good strategy there. Well, Daniel, how do we navigate these uncertain times to maintain that investment strategy for the legacy? I think that's a question everybody is asking, particularly now in these uncertain times.
Right. So I'm originally from Colorado, and there's the term getting over your skis. So I think that over the last, this happened pre-2007, 2008. It's been happening. Whether we'll have the same impact in overall recession, I obviously hope not, and it's also not my job to predict that. It's my job to, again, be ready for all circumstances. And so what we do is to buy, like I said, high quality assets, to leverage them in a smart way where you're not taking on too much debt risk, and also to invest with well-seasoned operators with a proven track record, which is key. That those kind of, I think, are if I kind of needed to identify the three items, that in terms of going into this unknown economy and in turmoil in the economy.
So it's buying a good solid asset that is going to last for a reasonable length of time, and leveraging it properly. Talk to us a little bit about the leveraging and how you arrange those leveraging deals there.
Well, it's very dependent on the economics of the deal. Obviously, in general, what we try to do is to put fixed rate debt on all of our deals, and if just as an example, I mentioned before that we took we did a lease up deal where we have to lease it up. So on those, you can't really do fixed rate right away. So we don't do it super high leverage. We try and be within the 60 to 70% leverage, and as soon as we can put fixed rate debt on, we do put fixed rate debt on. Most of our deals are fixed rate from the beginning, and again, and just to make sure that the cash flows are healthy. Now, I will say over the last year and a half, it's been very hard to do that, just because the properties have gotten bid up so high. The spread between the cap rate that is being bought at in debt has become so dense that it's been a real challenge to do that. But I think those fundamentals, is as close as you can get to that, are very important in terms of getting into real estate transactions that will last over the long period of time.
Yes, that leverage is so very, very important, and it makes such a difference when the economy does turn down. As long as everything's going along fine and you've got your units rented up, you can always make those mortgage payments. You lose tenants, then your first question is, how do I make that mortgage payment? And if you're just highly leveraged, it's going to be impossible to do that. Well, any other suggestions on what steps can be taken to build wealth for generations?
Other than items that we've discussed, I think I just want to reiterate that I think that the more important than the deal is the sponsor that's behind it. First of all, they should definitely have skin in the game. So with us, with HLC Equity, when we built out our platform for people to invest alongside us, it wasn't always a platform that people could actually invest alongside us. It was just principal capital, and then we opened it up for other investors. And so now investors like to know that, okay, they're doing this deal and we can invest with them, as opposed to sponsors that maybe in a different situation because they haven't done a lot of deals or so forth, so on and so forth. So I think it's really important, the sponsor, their track record, and the team that's behind it. And I think that that is most important, especially if you want to be passive, which is the beauty of investing in real estate today, is you can truly be very passive. And also we were talking before about mortgages and so forth. If you're a passive investor, you're an LP, you take on no risk other than your investment, which obviously is very important, but sponsors are taking on a significant amount of risk.
Well, Daniel, tell us how it is that we can get in touch with you, take advantage of your expertise and wisdom.
Sure. Well, so anybody, we welcome everybody to visit our website. It's hlcequity.com. It'll be in the show notes. And from there, we have lots of content that we put out. We just put out reports and an overall campaign that we're doing in order to kind of like shed some light on our thoughts on the 2022 economic outlook. So you can go on to, you can even go right to it. It's hlcequity.com/2022 outlook. And we have lots of other content, videos, lots of stuff there. And it would be great. Also, if people want to sign up for our newsletter, we have a newsletter that goes out. It's weekly, and it provides lots of content, lots of articles of stuff we're reading, and also internal content that we build. And it shows transactions that we're doing so that people can stay, informed.
And you also have a report on the current outlook on the economy. So viewers and listeners, take advantage of that. Go to that. Daniel, it's been wonderful having you today. Thank you for being a guest, and Enlightened Investors, delighted to be with you again today. I look forward to being with you next time.
Thank you. Thank you very much.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.